Keith Neumeyer, CEO of First Majestic Silver, is here with us to discuss the silver market and updates on his company. Keith is a very esteemed and renowned name in the silver space, and it's an honor to have you here talking about the space today with us. Thank you for coming on the show, Keith.
Great opportunity to talk about silver on such a positive day in the market.
Absolutely positive day in the markets, and we'll be talking about the silver market in a little more detail. But first, let's talk about your recent acquisition of Jerritt Canyon. So this is, you were talking to me offline, a little bit in the pivot in terms of your overall strategy for First Majestic Silver. You're adding a little more gold to your production. Tell us about the acquisition and your broader strategy.
You know, we've been actively pursuing a number of M&A opportunities for the last, 19 years. That's how I built the business, through acquisitions. And we've been in Mexico now for the life of the business, which, as I just said, 19 years. And it's our first investment outside of Mexico. You know, we looked around the world looking for, silver-centric assets, and they're just simply very hard to find. This asset in Nevada, despite it being 100% gold, for us, it's got enormous upside, and we just tucked it into our portfolio. It's going to give us more gold, of course, but that's not a bad thing. We're still more silver than gold. We hope that our strategy will develop into remaining a silver company, of course, and our next acquisition will be interesting to see what that looks like. But this Jerritt Canyon just has everything. It's got growth, it's got expansion, it's got the life of mine resources, big land package, great jurisdiction, Nevada being one of the best mining jurisdictions in the world. So we're just happy to be there and happy to put this asset into our portfolio.
Okay, so let's look at your latest quarterly results now. You had $100 million in top line revenue from the first quarter of 2021, which is up significantly from about 80 something million dollars last year of the same quarter. So it seems to me like production's picking up after COVID. Is that correct to assume?
Well, mostly that is price. Production in ounces was actually a little bit lower than the previous quarter, and that's usually fourth quarters generally in the mining sector, at least as far as I've experienced in my career. Fourth quarters are generally the best quarter, and first quarters are generally the softest quarter, and I think that's exactly what happened. And we're looking like we're having a pretty good second quarter. Then Jerritt Canyon on top of that, it's probably going to be a record quarter on a revenue basis, assuming metal prices stay where they are or even go higher as they currently are today.
Okay, perfect. And let's talk about your strategy now with expanding more into gold, which ties into your acquisition. Generally speaking, why are you thinking of doing this?
It wasn't intentional, and look, we know, of course, I'm in close relationships with our shareholder base. We know why they own First Majestic, because of the silver nature of the business, and it's something that is dear to me. I love gold, but I quite honestly like silver more. I think silver will outperform gold in this cycle that we're currently in, and over the next 5 years. And you've heard me on record a number of times, talking about triple-digit silver. So we're actively pursuing silver mines, around the planet, but silver mines are just generally very difficult to find good ones. And if we find one, then hopefully the stars align. But this particular acquisition, despite it being 100% gold, it just fit all the criteria, as I said earlier.
Okay, I'm looking at your share price over the last year, so last trailing 12 months. The share price of First Majestic has outperformed the silver price. So the company stock is up about 97% year on year over the last 12 months, while silver is up about 80-something%. Generally speaking, for a new investor coming into the space, if you were to explain to them why the company tends to outperform on the upside and perhaps fall down more on the downside, basically, why is your beta higher? How would you make that explanation?
Well, isn't that the reason why people buy mining stocks in the first place? If there was no beta, then why buy a miner? You might as well just go buy physical metal. The whole beauty of buying a good quality mining stock, it doesn't matter if it's silver or whatever, any metal, that mining company, its shares, should outperform the metal. And generally speaking, they do. And if you go back to the history First Majestic, there's been many times where that has been proven true. And when silver starts to move, the money starts to flow in this sector, and it's a tiny sector. And First Majestic is one of the leaders in the space, and a lot of investment capital tends to come our way, which affects the share price, which is obviously a good thing for shareholders.
Okay, so let's talk about the silver market then. Over the last year, again, significant run up in the silver price, gold as well, although both metals have tapered off a little bit since its highs. What was your reaction initially when you saw the price run up to, or for gold, at least for gold, to historic levels? Did it change your production plans at all? Did you reallocate resources to capture higher share price, silver and gold prices? What did you do?
Well, first off, I said to myself, it's about time. It's been, we went through a pretty difficult period, from 2012 to 2017 and 2016. And then we had a, bit of a pause in 2017, 2018, and things resumed again in 2019. So, being an investor in this space has not exactly been easy over the last, 5, 6, 7 years. And as an executive team, it's just as challenging, because we put budgets together at certain metal prices, and we anticipate, getting those revenues into the door so we can make the necessary investments to expand the business. And when the metal prices don't perform, then we have to cut back our investments, and that often includes, layoffs, or it could include canceling or postponing projects, and all these kinds of things. A start and stop type of activity that the miners are forced into sometimes do add to costs. Because it's expensive to do that. So we have to try to remain conservative as best as possible in order not to, go crazy on the CapEx side just because we see higher metal prices. Because even though, despite the fact that I think, we're going to see triple-digit silver, we are running a, large publicly traded company, and it is our shareholders' money. So, we have to be somewhat conservative when we're deploying capital. But, we are expanding Santa Elena right now with the Ermitaño project coming online. There's investment going into exploration at San Dimas, and so we're very focused on resource development, life of mine expansion, and now with Jerritt Canyon coming into the picture, same kind of strategy is going to be employed there.
And just quickly now on your strategy, M&A, you talked about not deploying too much capital on the CapEx front when prices run up. What about M&A? Does that do you have the same? Do you have to maintain the same discipline when you've got more cash flow coming in, and it's just tempting to buy up a company? How do you
well,
interpret that?
First off, we're all humans, and when price rises, greed rises. So it takes two to tango. It takes two groups to say yes to a transaction, and often when prices are running, as we've seen that they've done over the last couple of years, the sellers tend to shy away a little bit, and it's more challenging for the buyers to do deals. So M&A transactions do definitely slow down. The other hindrance to M&A, as I've said this before, is the lack of conferences. Mining conferences whereby the executives of all these mining companies are have a chance to see each other face to face and actually talk about deals and what things look like in the future, and that really helps or has helped historically M&A transactions. And without those conferences, I think that's also had a negative impact on M&A activity.
Let's talk about your triple-digit silver call. Now, you've been on the show in the past before talking about this longer-term outlook, and let's break down the fundamentals here and talk to us about how the market could get there. Let's start with the industrial component, and before we move on to the investment demand component, silver is in a unique position where you've got both components to consider. So what are some of the industrial applications today that you're looking out for that could potentially drive up demand?
Well, everyone that's listening to this podcast or this interview knows, my spiel and my bullish comments regarding the metal. I look at silver as a strategic metal, not so much as a precious metal, despite the fact it is precious. Going to the precious story for a second. In 2020, for every 1 ounce of gold mined worldwide, there was only 7 ounces of silver mined, which is a pretty shocking number considering we're trading at something in the order of 70 to 1 in the financial markets. So that's just that. Now, on the pure demand side, when it comes to whether it's the Green Deal or whether it's just the electrification of the planet or what have you, you look at copper prices, you look at commodities. Silver is really the only commodity that's not really reaching its highs that it has reached now on two separate occasions back in 1980 and in 2011. I think we're going to see that high breached in this cycle. And when it does, it's going to wake up the market. And that's what I think. Once it breaks through the $50 level, I think that it's going to get up to the $100 level pretty quickly. It might bounce around 70 or 80, who knows? But, I think those are the kinds of numbers, copper broke through $10,000 a pound yesterday. And, oil's on its way back to $100 a barrel. And, we're getting into a pretty inflationary time. And also you add the actual supply deficits on top of that with silver, you've got a perfect storm, just in the making, in my opinion.
Okay, so let's talk about that in just a bit. The strategic metal aspect that you brought up, that's a good point. Are you not concerned that should silver one day breach $100 an ounce in the triple digits, maybe there's going to be thrifting in the industry, people are going to use less silver? Would that be a problem?
Well, if you go to our website, you'll see there's no substitute for silver. Now, if you go back 20 years and look at solar panels, today there's less silver being used in solar panels due to efficiencies in the technology. So the companies, DuPont's, who produce this material for the solar panels, have been able to reduce the amount of silver used and also, at the same time, have the same power density. There's a limit to that, and it's likely reached now. So whether the solar panel industry can actually reduce silver even further, there's a lot of doubt around that. You could go to a very cheap solar panel, but the efficiencies are going to drop below 25%, and then the silver panel itself is almost uneconomic. So why even bother buying it in the first place? Other technologies like electric cars, that's not going backwards. I don't think, I think everyone listening to this would agree that the future is electric, and then probably after that, fuel cells, but that's probably 50 years on the road. But the next big move is going to be electric cars, and that's going to be a huge consumers of silver.
Okay, let's take a look at some of the investment components for silver now. I have a few charts from the Silver Institute, and this is an interesting table that they've showed in their latest report that came out 2 weeks ago. Silver supply and demand, they're actually reporting a net positive balance, so a surplus in 2020.
Well, if you look at the way that is actually, if you want to
let's go back.
Again, so you see the market balance less ETPs. They're actually showing a deficit of 251 million ounces. So I saw Kitco's headline a couple of weeks ago, and it's completely offside. Whoever wrote that article, unfortunately, didn't read this data, but ETPs should be on the demand side, because think about this for a second. This is why I've become against Metals Focus and GFMS. GFMS and Metals Focus are the two primary data collection services on the planet who put this nonsense out into the marketplace. GFMS is owned by BlackRock, which in itself, I'm surprised the regulators even let BlackRock own one of the most important news dissemination services for the metal sector on the planet. Metals Focus is a spinoff from GFMS. They use exactly the same methodology as GFMS does. And if you look at this in detail, you look at recycling, for example, at 182 million ounces. I'm really curious how they actually come up with that number, because most of the recycling actually comes from refineries and smelters, and most of them are privately owned, and they don't report. So finding recycling data is very, very difficult. Net hedging supply, that's a paper transaction. So why would you have a hedge as part of your supply, right? When that metal comes to market, I would agree it should be supply, but it's paper. So why are you including paper in your supply calculation? The flip side to that, if you're going to include the hedge on the sell side, so that hedge is a mining company selling metal into the future, right? Through a paper contract, not yet delivered. if you're an institution and you want to short the metal, when we all know there's a very large short position on the COMEX, that is future demand. So if you have 300 million ounces short on the COMEX, you should have demand there of a 300 million ounce hedge, right? Because that's your paper hedge. So you've got paper supply showing, but no flip side to that trade showing. So right there, these numbers mean nothing. You look at jewelry at 148. I was quite shocked with that number because online sales have exploded in 2020 due to COVID. And I'm curious why they're suggesting that jewelry's demand dropped. That just makes zero sense to me. Silverware dropping by 48%. I'm not even sure how they come up with that. Again, online sales have exploded. So why would silverware drop in 2020? Net physical investment, we know at 200 million ounces net physical investment compared to 185 million the year before, that is nonsensical. Our website was wiped out of all its silver in a matter of days. And I know for a fact that the whole space, because we're scrambling to fill our warehouse up again with physical metal, and everyone else in the world, because I talk to people in Europe and the United States on a regular basis that are very close to this market, and they can't get silver. And as far as I know, and what I've been told by people very close to this sector, that physical silver demand was the highest in known history in 2020. And they only show a 15 million ounce increase year over year, which in itself makes no sense. So, I think these numbers are made up. I don't trust them. And I wouldn't rely on these numbers at all.
Okay, fair enough. So I think what they're reporting now is the 80 million ounces in the surplus, which they've reported as the biggest surplus in their recorded history since they've started recording data. But then once you break it down, once you go down the ledger, it says here you're subtracting net investments in ETP, so exchange traded products, and that becomes a deficit. So you're saying that number should be subtracted? You should take into account that adjustment?
That,
no?
Assuming that 331 million ounces is correct, and I don't know, I'm assuming it's correct, but I have no idea whether it is or not, that should be in the demand line. That should be moved up. So why have it? Why have when you're when you're trying to figure out supply demand? Why would you have a line item called market balance? It's a plug, and I've said to members of the Silver Institute many times that most of these numbers are just simply plugs, and they, for the most part, they're meaningless.
Maybe they're not counting the ETPs because it's not they're exchange traded products. They're not physical silver, right? So they're not. It's not part
that's
of the
true.
Physical silver demand. I'm
right,
just
but
guessing
but they're showing hedging, which is paper as well.
All right. Well, it's good you clarified that, Keith. Let's move. I have two more charts from the report that I'd like you to clarify on. This is really the same thing, just in graphical format. So again, it's showing that there's more or less a surplus here going on. It's broken down into a graph. This is interesting. This is investors' positions on the COMEX here. So it's showing a spike in demand in late 2020, but it's since come down from its local peak there. Is that more or less in line with what you've observed, Keith?
I don't follow the COMEX positions that closely. I read probably the same stuff you read. So it's kind of hard for me to really comment on this. I'm more familiar with the actual physical flows versus paper flows.
Okay, so let's assume that let's go with your the data that you've observed and say that there is indeed a deficit in the physical market and that the numbers that they've reported can be disputed. What does this deficit mean for the price of silver going into potentially the next year?
Well, look, the guy that runs the CFTC just recently in an interview said they were successfully able to cap the market when it ran up to $30 an ounce. Pretty shocking statement from somebody who runs the exchange. Nevertheless, so there is definitely efforts to keep these markets kind of at bay whether it's the silver or gold market. And we I'm a big believer in physical demand will ultimately break the strangleholds on these paper markets, and that's what I advocate people do, and I suggest people continue to do that.
Can you just clarify what you mean by break the strangleholds? What exactly is that referring to, Keith?
Well, these silver prices, that's what we're talking about today, have been caught in this trading range for some 30 years. When I say trading range, I mean trading ratio, and you get used to that, and the banks get used to that, and when it gets at the top end of that range, they may decide to take on a bigger position. When it gets on the lower side of that range, maybe they do some other trading. I don't work in the banks anymore, but I kind of know how things work. But when you're Sony or Tesla or Apple, and then you just given one of the banks a big order for silver, and you need it delivered to various ports around the world for you to be able to manufacture your products, and all of a sudden one of the banks can't deliver to you, because of the physical metal's just simply not there. That's where I think we're headed, and I think it's going to be the retail investor who's going to cause the biggest issue for that event to occur, because we do have a new buyer in the market that wasn't there a couple of years ago. Since I put First Majestic together 19 years ago, there's been pretty much the same buyer in this market, and the banks are pretty familiar with the commercial demand. They obviously monitor that pretty closely. What they don't monitor and can't control is their retail demand. And that's my point. I think it's going to be the retail demand, and we saw glimpses of that in the Reddit, crowd that occurred, recently. And I think that momentum is going to continue. Our sales of our website just don't stop. We cannot get enough metal into our warehouse to fill the demand. We could probably sell at least 5 times our current volume, and that's a bit of a guess on my part. But if we had the metal in inventory today.
Do you have an estimate, and maybe have you thought about how many ounces or millions of ounces of physical silver that, going to the retail investors side, the retail investors need to buy and take off the market before the price moves up to break the stranglehold, like you said? Basically, how much more do we have to buy?
Yeah, it's a bit of a guessing game, of course, but the retail component of silver demand over the last 20 years fluctuates between 10 to 20%. And that's kind of been the norm, but, in 2014, 2015, the retail guys that are in this market couldn't give silver away. There was, virtually no demand. So it was down around the 10% range. Today, we can't get enough silver to supply to the retail space. And I don't know what those numbers are because they're not reported. And I said earlier that all the mints, all the retail sellers of products, even Kitco, I'm curious whether Kitco announces how much silver goes through their website every year, because for the most part, most people in this business do not report their sales publicly. And the refineries, the mints, keep this information very close to themselves. And that's why I question a lot of this data that gets put out by these news services, because I'm curious how they find it, because I've been in this business for 19 years and it's difficult. I've had, meetings with a lot of these guys that run these shops, and they won't tell you what they sell. So I'm curious how these groups get that data. But nevertheless, go ahead, sorry.
It is curious to me when I observed that data that I presented to you, that they reported a surplus in the physical market space, yet according to you and some other retail investors, there seems to be a shortage of physical silver bars and coins, gold as well to a certain extent, but less so. And so I'm curious as to where the discrepancy comes from. How can there be a surplus in the physical space, yet a deficit and shortage in the physical coins and bars markets? Can you explain that discrepancy, if there even is one?
Sure. Well, it's a fabrication issue for one. A couple of the big mints and refineries have gone bankrupt over the last couple of years because there's just so little business. So it's hard for these mints to actually meet the current demand. But it's also another issue. 1,000-ounce bars, which are the commercial material that gets delivered into industry, are the priority of the system. Those bars need to get into industry to produce products. So the banks will push because they have commitments to get this metal to the industries. So they push that metal. So the retail investor is really last in line. So it takes a lot of effort for some of these mints to actually go and source out 1,000-ounce bars to break them down into retail products. And I know for a fact, because I've seen photographs of silver bars arriving at some of the mints, where these bars are coming from. They're coming from places like Kazakhstan, parts of Asia. Now, these are old bars that aren't coming from traditional sources. The traditional sources have no silver, period.
So there's a supply chain bottleneck. So you're saying that needs to be fixed before the retailers can buy physical silver in enough quantity to move the market? Is that the summary here?
Well, we're already seeing it to some degree. I think the premiums that we're seeing of $5 to $7 an ounce, which is pretty historic. I don't recall ever seeing premiums as we're currently seeing today. That is driving demand to the paper markets because of the discrepancy in price. So I think there are more and more people coming into the paper markets, and we're seeing that in SIL, which is pretty well a paper machine. They don't really physical; they buy paper, and that they've been obviously adding a lot of paper ounces to their ETF. We've got the PSLV, which is a physical fund, which has also been adding significant ounces there. So we are seeing it. If the premiums continue to be where they are today, which I'm pretty sure they will, because I have no knowledge of any kind of major supply coming to the market to change the current dynamics, the premiums will drag up the paper price, in my view.
Okay, excellent. Keith, wonderful overview of the silver market. It's great to hear directly from a miner. And it's always good to have you on. I hope to have an update from you next quarter when your next quarterly results come in. Thank you very much.
Sure. Love to do it.
Okay. And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.